In January 2019, a single investor priced WeWork at $47 billion. 7 months later, the company filed the document that disclosed what it owed on its leases, $47.2 billion. The valuation and the liability were the same number, in the same summer, in the same set of filings. Only one of the two was contractual. 33 days after that filing hit the wire, the roadshow was dead. 47 days after, the registration was formally withdrawn. 4 years later, WeWork and 517 affiliates filed for Chapter 11 protection. The common stock halted near 84 cents, the entire equity worth about $44 million. This is not a story about a founder, a metric, or a culture. WeWork was a maturity transformation business, structurally a bank, run without a bank's capital requirements, without deposit insurance, and without a lender of last resort. The prospectus did not expose a fraud. It disclosed the trade to the only buyers in the world who priced duration for a living. At the time of filing, WeWork ran more than 500 locations across 29 countries, carrying roughly 527,000 memberships. The trade underneath was legitimate. Sign long master leases at wholesale, spend capital subdividing the floors, then sell the desks at retail by the month. Management targeted a 30% contribution margin over the life of a mature location, and about 70% of the portfolio had not yet reached maturity. The average initial term of its United States leases was approximately 15 years. The popular version of this story says the desks were rented month to month. That was the 2016 company. By June 1, 2019, the average membership commitment had nearly doubled, from roughly 8 months to just over 15. 15 years against 15 months. Management was closing the gap, and closing it far too slowly to matter. Two figures from the same document. Future undiscounted minimum lease payments, $47.2 billion. Committed revenue backlog, every dollar members were contractually bound to pay, $4 billion. Those numbers cover different horizons, so setting them beside each other is not a solvency test, and treating it as one is the standard error. The accurate reading is worse. The liability was fixed for 15 years. The revenue was contracted for about 1. Underneath the mismatch, the buildings themselves barely cleared. Location operating expenses consumed roughly 80% of revenue in the first half of 2019, before overhead, before marketing, before depreciation, and before the capital cost of the next building. For the full year 2018, revenue of $1.82 billion against a net loss of $1.93 billion. Approximately $1 of loss for every dollar of revenue. Which brings us to the metric, and to the correction most retellings get backwards. The phrase community-adjusted EBITDA does not appear in the August 2019 prospectus. Not once. It was invented 18 months earlier, for the April 2018 bond offering. $702 million of senior notes at 7.875%. The construction started at net loss, added back interest, taxes, depreciation, and amortization, and then also removed building-level operating costs, marketing, general and administrative expense, and design and development, which is to say it removed rent. A rent arbitrage business published an earnings measure that excluded rent, and a $933 million net loss became $233 million of adjusted profit. This was not vanity. It was aimed at high-yield bond buyers who underwrite off a leverage multiple, remove rent from the calculation, and a duration-mismatched landlord prints as an asset-light platform. The notes cleared. And by the time WeWork filed to sell equity, the metric had been quietly deleted and replaced with contribution margin. Yet every adjusted measure that survived into the prospectus was still negative. The transmission mechanism was written into a document signed one day before the filing. On August 13, 2019, WeWork secured commitments for $6 billion of credit from a syndicate of 9 banks. That facility was conditioned on the initial public offering raising at least $3 billion of equity. Access to the equity market had been converted into a funding covenant. WeWork was not going to run out of cash in September. It held roughly $2.5 billion, and outside analysts put the quarterly burn near $700 million, which placed the wall in early 2020, and the $6 billion was the bridge across it. When the auction refused the equity, the debt disappeared with it. No downgrade, no default notice. A conditionality clause did the work of a margin call. The founder's file did not cause the collapse, but it repriced everything else in the document. Class B and Class C shares carried 20 votes each. A succession provision gave Rebecca Newman a role in selecting the next chief executive, and a $1 billion charitable pledge was enforced by a clause that halved the family's voting power if they failed to give the money away. WeWork leased 4 buildings from entities in which Adam Newman held an ownership interest, and in 3 of the 4, the lease was signed the same day he acquired his stake. Future payments on those leases came to $236.6 million, 0.5% of total lease commitments. He was also paid $5.9 million in equity for the We family of trademarks, held by a vehicle he co-owned, and returned it in September under public pressure. The dollars were immaterial, the signal was not. The materially dangerous item sat elsewhere. Newman held a $500 million personal credit line from UBS, JP Morgan and Credit Suisse, roughly $380 million of it drawn, secured by a pledge of his own high-vote shares. JP Morgan was simultaneously lead underwriter on the offering and a lender against the stock it was marketing. A falling mark did not simply hurt shareholders. It triggered a collateral call on the control person. On September 13th, the company cut the super voting stock from 20 votes to 10 and stripped out the succession clause. It was not enough. The offering was shelved in mid-September. Newman resigned as chief executive on the 24th, and the registration was withdrawn on the 30th. In November, 2,400 employees, 19% of the company, were let go. There was no listed stock, so the only continuously priced WeWork instrument on earth was that bond. It changed hands around 105 cents on the dollar before the filing, and 83 by early October, a repricing of roughly 20% in 6 weeks, with nothing about the leases changed. Meanwhile, the exposure had already been distributed. WeWork was a top 5 tenant at 36 office properties, securing more than $3.3 billion of commercial mortgage-backed debt, and 78% of those loans had been written in the prior 3 years. The mismatch had been underwritten, tranched, and rated. In late October, SoftBank took control. $5 billion of new financing, up to $3 billion to buy existing shares, and $1.5 billion of equity pulled forward, about $9.5 billion in total, at a valuation near $8 billion. SoftBank took roughly 80% of the economics and deliberately declined majority voting rights, so that WeWork would be an associate rather than a subsidiary. 80% of the upside, and none of the lease liability consolidated onto its own balance sheet. The exit package was reported at up to $1.7 billion, as much as $970 million for his shares, $185 million in consulting fees, and a $500 million credit line, which was a loan and not a payment. It was an offer, not a transfer. SoftBank canceled the tender in April 2020. Newman sued, WeWork's own special committee sued, and the matter settled in February 2021 for materially less. The largest single component was always SoftBank buying stock he already owned. Then the pandemic did to the short side of the book exactly what the structure could not survive. And in the wreckage, WeWork found its only real lever. Under a credible threat of insolvency, landlords will negotiate. Across the restructuring, the company amended more than 590 leases and removed roughly $12 billion of future rent obligation. Its single most productive activity was the threat of its own bankruptcy. It reached the public market anyway, through a blank check merger in October 2021 at about $9 billion. By August 2023, the filing carried the words substantial doubt about the ability to continue as a going concern, with management naming lease obligations as the primary obstacle. In October, the company declined to pay roughly $95 million of interest while stating it had the cash to do so. That is not distress. That is a 30-day clock, opened deliberately. On November 6, 2023, WeWork filed Chapter 11 in New Jersey. Press-reported schedules showed roughly $15 billion of assets against $18.6 billion of liabilities, but most of that liability was capitalized lease, not borrowed money. Actual funded debt was about $4.2 billion, almost entirely secured. And under the bankruptcy code, a landlord's claim on a rejected lease is capped at the greater of 1 year's rent or 15% of the remaining term, not to exceed 3 years. So the 15-year duration that destroyed $47 billion of headline equity was converted, by statute, into an unsecured claim of at most 3 years, ranked behind the secured paper and paid in cents. WeWork emerged in June 2024, having eliminated more than $4 billion of debt and cut its future lease obligations roughly in half. Yardi Systems took about 60% for $337 million, and the common stock was canceled. SoftBank had committed roughly $16 billion to the company. It recognized a loss of more than $14 billion and wrote the position to zero. No enforcement action was brought against the control person, and the reason is structural. The related party leases, the 20-vote stock, the succession clause, the $47.2 billion of lease obligation, every one of them was in the prospectus. Securities law punishes concealment. It has no remedy for a fully disclosed bad idea. WeWork ran the oldest trade on the book, long the fixed liability, short the cancelable asset, and that trade survives only on the confidence of one funding counterparty. On August 14, 2019, that confidence was put out for auction. The duration gap was never funded. It was only ever financed.